All right, everybody, welcome to the September conference call. This is for Allstarcharts premium members. We have a lot to talk about today, so I'm not going to waste any time. Let's just dive right into it. So let's talk about what we're going to go over today, just so you guys have an idea. We're going to go in a maybe more traditional format. We're going to start with the U.S. averages, kind of go over some of the indexes, some important levels. Then we'll go into the international stuff. You know, I have been unapologetically bullish during all of this quote-unquote turmoil. I don't see any turmoil. I see a very perfectly normal market environment, very healthy. So, you know, just throw all those news headlines into the trash because they've obviously not served any purpose. So we're going to talk about both developed and emerging markets. Then we're going to go into U.S. sectors, both on a relative basis and absolute. We obviously know the market is in an uptrend, contrary to popular belief, but there are some sector rotation taking place that I think needs to be noted. We're going to dive into the subsectors and then the best of the best stock ideas. So we're not going to be looking for the biggest piece of garbage to bottom fish and you know, hope for the best. We're going to be in strength. I mean, we're looking for two things. We're looking for momentum and we're looking for relative strength. And I'm going to show you guys some of the stocks that are showing both of those, and there's a bunch of them. So there's a lot of opportunities. We're going to go over commodities and currencies, guys. The Commitment of Traders report from last week has taken these commercial hedgers in euro and precious metals to further extremes. So and some of the agricultural commodities as well. So what the smart money is doing has really helped us in the past. You guys that have been around for a while know that, and I think that this cycle is no different. We're seeing a lot of the opposite sort of positioning that we saw coming into the year 9 months earlier. So super interesting, and then we're going to finish up with some interest rates and some credit spreads that I think are worth watching for sure. As you guys know, nothing that we talk about here, guys, is any sort of solicitation to invest in any hedge fund that I manage or will manage in the future. These aren't buy and sell recommendations, so just make sure that you consult your compliance officer if you're in the business. Obviously, a lot of financial advisors out there, you know, or just make sure that if you are not a professional, that you are consulting your accountants and your financial advisors to make sure that you're suitable to be doing some of the things that we're talking about. So this is strictly for informational purposes alone, guys. Just remember that. All right, so let's dive right in. You know, people talk about technical analysis and head and shoulders and all this garbage. You know, let's go back 130 years to stuff that continues to work. You know, we have two averages. We have the Dow Jones Industrial Average and we have the Dow Jones Transportation Average. And when they've diverged in the past, like in 1999, 2000, like in 2008, 2011, 2015, you know, they've led, you know, to turns, and we don't have any of that right now. So we can go back to the oldest theory in the history of technical analysis that we're aware of, Dow theory. You have the Dow Jones Industrials making new highs, the transports making new highs. I see nothing wrong here. Here's a little trick that I picked up from some of my colleagues over the years. We take that same Dow theory and we apply it to large caps and small caps, right? So we want to see if the large cap S&P 500 is making new highs. We also want to see the small cap Russell 2000 making new highs as well. In the past, when we've seen divergences there, you know, they have led to turning points. So we want to treat it the exact same way. So far, we have the S&P 500 today closing at an all-time high, and small caps aren't quite there yet, but I have a funny feeling that will take place. So I just wanted to go over something. Today is Tuesday, September the 12th. We had an all-time high close for the S&P 500, the Dow Jones Industrial Average, the NASDAQ Composite, the NASDAQ 100, the New York Stock Exchange Composite, the Russell 3000. You know, these are not things that we find in downtrends, guys. These are just very normal characteristics of uptrends. I mean, this is very normal. So the things that we want to point out that are not making new highs: precious metals are not making new highs. Bonds are not making new highs. Yen is not making new highs. So these quote-unquote safe haven assets are not making new highs. Stocks are making new highs. So I just want to make sure that we are fully aware of that, and we're putting all of that into context while we're looking at these charts, right? So here's the S&P 500, 2,400, you know, has really been the level. I've consistently been saying throughout the summer, if we get any weakness towards that 2,400, we want to be buyers of that weakness. We didn't quite get that low, but we got to what, about 1420 or something like that. So we did get a little bit of weakness that we could have bought into, but really not that much weakness. And I think the fact that we didn't even get down to that support of 2400 in and of itself is a bullish signal. Look at momentum, how it's nowhere near oversold. And for you guys that are new, I know that we have a lot of new members, particularly all over the world. If you go to allstarcharts.com and you go to education, okay, I just want to show you guys real quick. You can go to helpful tools, and I'm going to be adding a ton of this in the next couple of weeks, so just a heads up. You go to momentum or Japanese candlesticks or Fibonacci, and you're going to get a full explanation as to what I'm talking about here. So if you're not 100% sure, go to allstarcharts.com, then education, and you could check that out. So I'll just assume we all know what we're talking about here. If not, go back and check it out. Definitely worth reading. So moving forward, again, that 2400 level continues to be very important. I see absolutely no reason to be bearish or neutral if we are above that. We want to be aggressively long, not just a little bit long, but very, very long. We want to be buying stocks. That has not changed. That has been my MO for a while, and I see no evidence to change that. To the contrary, all the data and evidence that keeps coming in continues to confirm that we are on the right side. So I think we're going up above 2600, guys, in the S&P 500, 2670. You know, we got another couple of hundred points to go. I don't think this is going to end anytime soon. Same thing with the Dow Jones Industrial Average, guys. You know, we're looking at about 21,500, 21,400 as this support. So we want to continue to buy weakness in this area, like the S&P 500. We didn't even get close. Momentum is in a bullish range. Remember, guys, that the strongest uptrends, momentum doesn't even get below 50. Yet alone oversold, and that's what we have here in the Dow Jones Industrial Average. So very bullish characteristics, nice uptrend, all-time high close. You know, nothing to really argue against. I think we're going to 23,200 is the next stop. So another 1,000 points to the upside in the Dow Jones Industrial Average. And this chart is as of yesterday. It doesn't include today's gains. The Dow Jones Industrial Average futures closed at an all-time high today as well. Just look at the very clean, consolidation. I mean, ask yourself, does this look like a major topping pattern, or does this just look like a very normal, healthy consolidation within an uptrend? I would argue it is the latter, not the former. I don't see this as a major top. I see this as a very healthy digestion of gains that is now resolving in the direction of the underlying trend. I mean, nothing could be more normal. Here's the Dow Jones Transportation Average. You know, here is that key resistance from late 2014, early 2015. I mean, we have been doing absolutely nothing for 6-7 months, and now I do believe we are finally breaking out, and the Dow Jones Transportation Average is most likely headed towards 11,000, which is another 1,500 points at least to the upside. I mean, that's a long way to go. Just look at this. Here's a daily chart of the transports, guys. Just a really healthy consolidation throughout this entire year. A couple of false starts, for sure during the summer, but nothing to change the trajectory of the trend. To the contrary, I think the fact that it's taken longer is probably more bullish, because the bigger the base, the higher in space. So I think that this is just more fuel. Notice how momentum never hit oversold conditions on any of these corrections. Guys, all bullish characteristics. If we are above 9,300 in the Dow Jones Transportation Average, we want to be very, very, very long. Again, don't misconstrue any sort of if-then statements for pessimism. I don't see any. We want to be very, very long, guys, for sure. New York Stock Exchange Composite, this, now we're getting more international. Remember, this is a market cap weighted index where more than half of these stocks are from outside of the United States. So, a lot of ADRs, and here we are closing at an all-time high. Momentum nowhere near oversold conditions this year. So 12,600, 12,700. I think we have a long way to go. There's a lot of these charts that have upside targets substantially higher. Couple hundred points higher in the S&P 500, 1,000 points higher in the Dow Industrials. I mean, now we're talking about another 600-700 points in the New York Stock Exchange Composite. These are very high targets, which is why we want to be very long, not just a little bit long. Russell 3000, this represents 98% of approximately 98% of all investable assets in the U.S. stock market. Never hit oversold conditions, making new all-time highs. You know, this 1400 has been the level. We continue to remain above it. I think we're going above 1600, guys. We have a long way to go in the Russell 3000. This includes small caps, mid caps, large caps. You know, people talk about the lack of breadth in the market. I don't know what the hell they're talking about. This is 98% of all of the stocks, all of the money that could possibly be invested in the United States, and it's making an all-time high. So when people talk about a lack of breadth, I think it's more of a lack of common sense is really what I believe that they're seeing. Here's the NASDAQ Composite. I mean, this is the granddaddy over here, and we are closed at another all-time high today. So that's 6850, and the NASDAQ Composite continues to be the target. That has not changed. We've been very, very bullish. This is one of the strongest ones for sure. You know, it's got a lot of technology exposure, biotechnology exposure, some of the biggest consumer discretionary stock, also in the NASDAQ, and Amazon. You also have Netflix. So, you know, definitely a lot of upside in the NASDAQ Composite for sure. As long as we are above that uptrend line from the 2016 lows, I see no reason for caution. To the contrary. Here's the Russell 2000, beautiful sideways consolidation. This thing's been going on for like 9 months where we've gone nowhere. So, you know, people, particularly the most ignorant people who continue to talk about how the market is frothy or overvalued or how it's gone too far too fast or whatever nonsense they're making up today, look at the Russell 2000 that's done absolutely nothing for 9 months. So I would argue that this is the exact opposite of frothy. To the contrary, this is a beautiful base that I believe we are now breaking out from, and we are heading above 1500 in the Russell 2000. Here's the mid cap 400, very similar to the small caps, probably a little bit stronger, but very similar, has kind of done nothing. I do think we get an upside resolution here. Notice how momentum never hit oversold conditions. We have mid caps confirming what we're seeing in small caps. And then here are the micro caps. I mean, these are the riskiest ones. These are the little guys. These are nothing. And I also think that this consolidation that's been taking place throughout 2017 is going to break out to the upside. So with the Russell 3000, S&P 500, and other large cap indexes making new highs, we are now seeing rotation into the small caps, mid caps, and micro caps. And that is, by definition, breadth expansion. These are more stocks participating to the upside, guys. So here's the Dow Jones Composite average. This includes all 30 Dow Jones Industrial Average stocks, all 20 stocks in the Dow Jones Transports, and the Dow Jones Utility stocks. So 65 stocks, 65 of the most important stocks in the history of the stock market. And here we are today, closing at an all-time high. So I think we're going towards 8,600 in the Dow Jones Composite average, which is not a little bit higher, it is a lot higher. So you have further evidence to not be kind of bullish, more evidence to be very bullish. And then here's a closer look at the Dow Jones Composite. You know, I see very clean resistance in March, nice consolidation. We got a breakout in the summer. We have held that breakout, and now we are now making all-time highs. Momentum got nowhere near oversold conditions. This just looks like a very normal, healthy uptrend. I see very little here to be pessimistic about, just further evidence that we not only want to be long, we want to be very long. S&P 1500, this is the small caps, the mid caps, and the large caps. Not just large caps, not just a few names, 1,500 freaking stocks, and we are now closing at an all-time high. Momentum is in a bullish range, higher highs, higher lows. You know, as long as we're above this 555 area that we've been pointing to, I see no reason to be bearish. I think we're going to 620 in the S&P 1500. Again, that's not a little bit higher from here. That's a lot higher. So, you know, again, we always weigh the evidence, and we take the weight of the evidence to come to a conclusion. Sometimes that conclusion is, hey, let's be neutral, or hey, let's be bearish, or hey, let's be bullish. Sometimes it's let's be really bullish, particularly like last summer, for example. I think we're in that scenario now. Here is the S&P ADR index, which represents the ADRs, obviously, and you know, new multi-year highs again today. We broke out above the downtrend line from the 2014 highs, successfully retested that key support, and are now making new highs. Momentum in a bullish range. I really see no reason to be bearish, just further evidence to be very bullish. And I think we go retest those 2014 highs, which once again is a lot higher from here, not just a little bit higher. Here's the London FTSE 100. I continue to point to this as maybe one of the most important charts on earth, simply because it's one of the most important indexes in the world, you know, top 3, top 5 most important indexes in the world. And we are coming out of a 20-year base. So these idiots that are telling you that, you know, we are in the 9th year of a bull market, or you know, how it's too frothy, or how stocks are overvalued. London did nothing for 20 freaking years. 20 years did nothing. And now we're coming out of this monster base. I cannot, and I'm going to stress this again, I cannot be bearish stocks as an asset class if the London FTSE 100 is breaking out of a multi-decade base, period. Here we're looking at it, 71.20. That's the level. If we start breaking below here and London FTSE 100 is trading down here, then you know what? We can say, wow, that was a major false breakout on the FTSE 100, and you know it's tough to be bullish. But until that happens, it's impossible for me to be bearish with the FTSE 100 doing what it's doing. Here's Canada. You know, Canada really has just not gotten the memo that stocks are in an uptrend. This is the longer-term chart, so you could see that it really hasn't had that breakout that we've seen in most of the other countries. So here's what it looks like, guys. And this is Canada priced in Canadian dollars, which is obviously part of the problem. And there's a lot of exposure and energy and things like that. So, but that's not an excuse, because 40% of Canada is banks. So I don't want to hear it. It's just an underperformer. Until we break out, I see very little reason to be aggressively long Canadian stocks, particularly on a relative basis. They keep making new lows relative to U.S. stocks. So it's not really anything that we want to be forcing right now. But I will say, if and when we do get above there, and I do think the weight of the evidence is pointing towards an upside resolution eventually, then we'll worry about it. In the meantime, you know, this is we want to be focusing on areas that are showing relative strength, that are showing bullish momentum characteristics. Canada isn't showing either one of those. So, you know, not everything is both hunky and dory. There are some areas that are just not behaving the way that they should, considering how their counterparts are behaving. Here's the equal weight version of Canada's index, and you know, it looks even worse. So not anything we want to be bothering with at this point. Here's Europe longer term, guys. The Euro Stoxx 50, just massive consolidation. You know, you talk about how stocks are frothy, everything like that. I mean, Europe is still in a 20-year downtrend. I mean, come on, guys. You know, there's nothing frothy about this market. To the contrary, I think there's probably a lot of pent-up demand that it either needs to chase stocks because they haven't been involved, or shorts that need to cover, or you know, whatever the case may be. But I mean, look at Europe down, you know, down for over the last 20 years. I mean, what's frothy about that? So here's Europe against the United States. I find this chart very fascinating in this rotation, this country rotation, where you know, U.S. has been the outperformer for as long as we can remember. Here is Europe putting in its low relative to America last summer. And then here this summer, we kind of put in a failed breakdown and are now potentially could see a squeeze in European stocks relative to the U.S. And I'll show you now what I'm seeing. Here's Germany. Here is the high in early 2015 in Germany. Here's the breakout, successful retest, and now we're breaking out again. I mean, just look at Germany breaking out. So I think that there's a lot going on with European equities, and you know, I've been saying that if Germany is in a bullish range in momentum and above the early 2015 highs, it is impossible for me to be bearish equities as an asset class. I mean, to the contrary, this is evidence that we are in an uptrend. We're breaking out of a multi-year base in the German DAX. Indexes don't get more important than the German DAX. I mean, think about it, guys. London, Germany, Japan, United States, I mean, these are the most important indexes on earth, and they're not making new lows, they're making new highs. I mean, this is an uptrend, there's no question. Here's France. You know, I also think this resolves higher, further evidence that, you know, Europe is in an uptrend. Here we are short term. This chart is from this weekend, guys, so add a couple of up days here, and we are now getting a breakout in France, confirming what we're seeing in Germany, so it shouldn't be a surprise. The Belgium 20, not an index that many people follow. I kid you not, guys, over the last several years has turned into one of my favorite indexes. You know, it's turned into a leading indicator. It has provided us with so much information. I've never traded a Belgium stock in my life. I may never trade a Belgium stock in my life. I like the beer though, but that's about it. And I like the charts. It's been a great leading indicator, there's no question, and it's been evidence of risk appetite. This chart is from this weekend, a couple days old, so this is now breaking out, and it held the former resistance from early 2015. So I think Belgium's goes to 4,400. Another example of upsides not being a little bit higher from here, but being a lot higher from here, okay? Here's Netherlands. Again, this chart's a couple of days old. Nice bullish momentum divergence. I think we're going a lot higher in the Netherlands. 590 in the AEX. Again, not a little bit higher from here, a lot higher from here. Here's Italy. This is also a couple of days old, so we've gotten the breakout that we were looking for, but similar to Belgium, just, you know, the Italy, the MIB, the Milano Italia Bolsa, is not an index that is very widely followed for whatever the reason. Similar to Belgium, it has just given us so much information with respects to risk appetite. I mean, look at that failed breakdown last summer when we got so bullish of European stocks. I'm telling you guys from the bottom of my heart, Italy played a role in making the decision to get very aggressively long everything last summer in 2016. So here we're looking at European banks. So we are still in a strong downtrend going back to the highs in 2007. This is priced in euro, keep that in mind. And now here we're looking at the European Bank Exchange Traded Fund, the EUFN, which is US dollar denominated. So in the short term, so long term, let's just go over this, long term in euro, still a downtrend, but in pricing US dollars, here we had resistance in the spring, we broke out in the summer, and now successfully retested that. I mean, I see very normal, very healthy polarity taking place, former resistance turning into support. To me, this is just very normal behavior from stocks. There's no question. Here we're looking at European banks priced in euro. So this is the US exchange traded fund, but euro denominated. Notice how momentum never got oversold. A nice little failed breakdown. I think we get a major squeeze in the European banks. Take a look at Deutsche Bank in particular. And if you have any questions on that, just shoot me an email. Here's EFA. It's an ETF that basically represents Japan and Europe. I'm not sure exactly off the top of my head what the percentage is, but it's like, I don't know, like 60%. It's a lot. So when you look at this, it's basically just a great gauge of how Europe and Japan are doing, which are very important markets, obviously. And I think we're going a lot higher. I still think we go retest those 2014 highs. So the path of least resistance in Europe and Japan is higher. Notice how momentum has gotten nowhere near oversold conditions this year. That's a bullish characteristic. Here's Japan. Momentum never got oversold. I do think this is a failed breakdown, and we get a squeeze to retest the 2015 highs. So that's what we're looking at in Nikkei. Australia, people talk about how the United States may be frustrating market or whatever it is. You want to talk about frustrating markets, look at Australia. It has literally done nothing for 3-4 months, just a sideways grind. I can't remember the last time I saw anything like this. So based on the weight of the evidence, I do think we get an upside resolution, and if that's the case, we have a long way to go. But similar to Canada, you know, it's got some exposure in some underperforming stocks and sectors. So that might have something, you know, that most likely has something to do with the underperformance. But not a bearish chart is really my point. So here's emerging markets breaking out of a downtrend line from the 2007 highs. I still think that we're going to above $50. You know, that's another 15% from here. That's not nothing. You know, that's further evidence that we don't want to be kind of bullish. We want to be very bullish of stocks and buying very aggressively on any weakness. That approach hasn't changed, but I just want to reiterate that not only has that approach not changed, the evidence and the data that we're getting suggests that we should continue to err in the aggressively long sort of approach. Here are emerging markets relative to the S&P 500, you know, major multi-year bottom is what I see and breaking out. So, you know, while I love emerging markets and I think EEM can go up another 15%, I think it's going to continue to outperform the United States like it's been doing all year. I think that we could be in the early stages of a major bottom on a relative basis. Remember, you know, people talk about how the United States is frothy and overvalued and all this nonsense. But let's remember that the S&P 500 broke out of former resistance in 2013. Emerging markets were in a downtrend during that entire period and didn't bottom out until early last year. So there's a lot of catch-up being done, obviously, in the emerging market space. Hey guys, this is JC Peretz, and you are listening to the September conference call for members of All-Star Charts. Right now, we're talking about some of the international markets. If you are a member of All-Star Charts, you would go to JC's chart book, and you could quickly go in there and see what some of the international markets that we're looking at, everything from London to some of the emerging markets. You can even click on that individual workbook, and it will take you to the entire list of international markets. Let's say, for example, I want to know what Lithuania is doing. Just click on Lithuania and it will take you right there. So as you can see, this is very mobile friendly, and you can use all sorts of different platforms to use it, not just the computer, but the iPad and everything like that. So just go to allstarcharts.com/Q4profits. allstarcharts.com/Q4profits, and you could just log in, and here's the 30-day risk-free trial. You can either have a quarterly membership for $297, which is normally $397, or the annual membership for $997, which is a lot less than the traditional price of $1297. And the best of all, you get a 30-day risk-free trial. So I hope you're enjoying the conference call. I'll let you finish listening, but make sure to go to allstarcharts.com/Q4profits. Here's New Zealand, continuing to make new highs. I think New Zealand goes above 8,100. So, I just want to show this, not because we're going to go out and flip the book long, New Zealand stocks, but just from a risk appetite versus risk aversion sort of perspective. New Zealand making new highs is not evidence of distribution, it's evidence of accumulation. Here's more further into emerging markets. Here's India, Nifty 50. I still think that there's a long way to go in India. I think we're going to go between 10,500, 10,600 in the near term. China making multi-year highs, or whatever, year and a half year highs. That's not a bad thing. I mean, they're buying China. Look at Taiwan breaking out of a 20-year base. 20 years, guys. Taiwanese stocks did absolutely nothing for 2 decades and are now breaking out. Like, you talk about stocks that are frothy and overvalued. Taiwan hasn't done anything in 20 years. What do you mean frothy and overvalued? Come on. So here we're looking at it on a short-term basis. We took out the 2015 highs. We're now breaking out 11,750. That's where I think we're going. That's another 1,200 points in Taiwan. That's not nothing. It's further evidence to be really bullish, not just a little bit bullish. Here's the ETF that we've wanted to be long since the breakout above 34. Target still above 41. I still think that's where we're going. We want to be buying any and all weakness in Taiwan. Here's Thailand breaking out of a downtrend line going back several years. Further evidence that this is the actual index itself priced in Thai baht. And this is further, think about this, guys. You think that Thailand breaking out of a 4-year base is evidence of distribution, or is that evidence of accumulation? Let's really put things in perspective. Here's Brazil making all-time highs. This is Brazil. You want to talk about emerging markets and some of the most important emerging markets in the world? Brazil is one of them, and we are making new highs. This is EWZ. This is the ETF that we've wanted to buy for above 40 bucks. I still want to own it. I think we're going to $54.50. I think we're going back to the 2014 highs. That's $54, guys. That's 12 points from current levels. We're talking 20, 30% higher potentially in Brazil. Further evidence not to be kind of bullish, further evidence to be very bullish. So, if I ever use the words cautiously optimistic, just punch me in the face as hard as you can. I beg of you. This is not one of those situations. We are not cautiously optimistic. We want to be buying stocks aggressively. Here's Latin America. I still think we're going to 41. That's another 15% from current levels, guys. The trade has been to be long above this form of resistance. We have been above this form of resistance, and I still think we're going higher. We want to be buying ILF, guys. Here's Latin America relative to the United States, similar to emerging markets relative to America, putting in a bottom, breaking out of a consolidation. This is further evidence of accumulation, not distribution. Here's Russia. Russia's a very interesting scenario because we're seeing Russian stocks doing really well with oil not doing well. So there's something there. We're going to get to that in a minute, but I just want to point out that Russia is breaking out of the downtrend from this year, before oil, before energy stocks. So there's something going on here in Russia, and I think we need to pay attention to it. This is the Russian RTS. This is priced in US dollars, by the way. So it's not something that's priced in local currency. This is in USD, and we are breaking out, not breaking down. further evidence of accumulation, not distribution. So back to Russia in a minute, guys. There's something going on there that we're going to talk about in a minute, but I just want to leave it at that for now and show the Philippines, also similar consolidation and breakout. South Korea, look at the highs in 2014. We are retesting that successfully. We want to be long EWY if we're above 67.75 with a target above 83. That is a long way to go. Remember, there's a lot of Samsung here, so this is more of an emerging market technology story as opposed to an emerging market metals and mining and commodity story and energy, right? This is different. This is tech. And then here are frontier markets. You know, people talk about risk aversion and risk appetite. Guys, these are literally the worst stocks in the history of stocks. This is like Nigeria, Argentina, Kuwait. Like, these are the worst. And they're going out at multi-year highs. So do you think that the worst stocks and the worst countries and the most speculative investments making multi-year highs is evidence of distribution, or is that evidence of accumulation for stocks, right? So again, further evidence that we don't want to be kind of bullish. We want to be very bullish here. Here we're looking at, you know, we talk about how the emerging markets and some of these BRIC nations, right, Brazil, Russia, India, China, South Africa, Korea, they are coming out of multi-year downtrends, 5-6 year downtrends. Here we're looking at an equally weighted chart of the currencies from these BRIC countries, and we are also breaking out. Remember, this is not like America and the US dollar or Europe. The emerging markets tend to move with their currencies. So we are not only seeing breakouts in the stocks, we are also seeing confirmation from the currencies as well. So notice how momentum never got oversold this year in this equally weighted index. So further evidence of accumulation for emerging markets. Now, taking it back to the United States, I want to bring in the Wilshire 5000. Now that we've taken a look at what's happening around the world, let's bring it back to the United States and show the Wilshire 5000 in an uptrend, making new all-time highs, not new lows, guys. If we are above this 25,000 in the Wilshire 5000, we want to err on the long side. If we're down here, then we got a problem. But we're not down here. We're up here. So, by the way, look at that next target in Wilshire 5000, 27,800. You know, we got 2,000 points in Wilshire to the upside. That's not nothing. Here's the global Dow, guys, which includes other countries, of course, going out at new all-time highs for the global Dow. And then here's an index that I created where I take the top 10 stock markets in the world, both developed and emerging, right? So not just Japan and Germany and Australia, Canada, US, right, and London, but also Brazil and the emerging markets. So it's the top 10 equally weighted, and we are now making all-time highs. So we are coming out of a 10-year base, breaking out to new all-time highs. I think we're going to 211 in this particular index. So look how much more room we have to hit that target. So further evidence to not be a little bit bullish, but to be very bullish. Here's a shorter-term look. I think short-term we go to 186. That's still another 10 points higher in this index. I think we're going a lot higher. Go to Allstar charts, and you can go to the international market index workbook, and you'll find this at the end updated. So here are the BRIC stocks, right? So we look at the currencies from the BRIC nations. Now we're looking at the stocks themselves, and equally weighted Brazil, Russia, India, China, Korea, and South Africa, breaking out to new highs. Here we're looking at the BRICS relative to the United States, right? So Brazil, Russia, India, China, Korea, South Africa, relative to the S&P 500, coming out of a major base or trying to complete a major base. To me, guys, this is evidence of accumulation, not distribution. So further pointing to that strength that we're seeing in emerging markets. You got guys like Donald Trump, right? Like to play around with the Twitter, and you know they talk about, you know, he likes to remind America how, you know, we're making all-time highs since he became president, and you know he thinks there's a correlation there. I want to point to, I don't have any, you know, political, you know, beliefs and bring them into the stock market. These are two different things. I'm just using him as a specific example, but I want to use what he's doing and look at what the rest of the world is doing. So here's the S&P 500 making all-time highs, but then here we're looking at the Global 40, right? So the Global 40 is an equally weighted index that I created that is not just the top 10 stock markets in the world, it's the top 40 stock markets in the world. So pretty diversified look at what the world is doing. It's the Global 40. You can find that in the International Indexes workbook towards the end. So what I did was I took the Global 40 and I took the United States out of it, right? So it's the next 39 countries after the United States equally weighted, and call me crazy, but they look exactly the same. So people who don't look at international markets, I think that they are, really selling themselves short. I think that we have to look at international markets, and I think this chart that shows that they basically do the same damn thing is further evidence that we need to look at the rest of the world and not just be narrow-minded in between U.S. borders. So let's get into U.S. stocks. It's a growth over value story, guys. That has not changed at all. I did see today that the low volatility index broke out to a new all-time high, so that's interesting. So we might see some dynamics changing, but from a structural perspective, growth over value, guys, that has not changed, and I think we're going to 110 on this ratio. This is one of the most important relative strength lines that we have in our arsenal. This is consumer staples relative to the S&P 500, and it has a very strong negative correlation with U.S. equities. So if this ratio is going up, in all likelihood, stocks are going down, and if this ratio is going down, in all likelihood, stocks are going up. So we have been looking for a major breakdown in this ratio as a catalyst to send stocks not just a little bit higher, a lot higher. We want to see this ratio crashing. We want to see as bulls, we want to see this ratio down here. So XLP versus SPY, I think, should be one of the main charts on our radar. If we get a crash here, we're going to get a squeeze in stocks, and I think it happens soon. So this is a ratio we want to watch closely. Guys, I got to tell you, look at this bullish momentum divergence. This is energy relative to the S&P 500, so energy stocks, XLE versus SPY. This seems like a logical area for this ratio to bottom out. It was former resistance 20 years ago or 18 years ago. Bullish momentum divergence, I think we could potentially see a squeeze. So something that we want to watch. Until we're above those former highs, I think it's a little early, but I think it would be irresponsible not to see what's actually taking place here. We could be, I would be surprised if 3 months from now we don't look back to today and be like, wow, that was the bottom. I would argue that there's probably a really high likelihood that that was the bottom. So here's energy itself. What a mess. And I still think that there's some overhead supply. So do we want to just blindly buy energy? I would say no. But let me just go back real quick. But the fact that the relative strength could be improving, I think, is great. I mean, these are huge market cap stocks in a cap-weighted world. So the fact that they're not crashing anymore is a tailwind for stocks, not a headwind. So we want to get above that, but under 69.70, there's still trouble. Talk to me once we're above 70 in the XLE. Same thing with the OIH. These are the oil services. Still a downtrend, still some trouble. Not anything we want to be aggressively long right here. But oil refiners are a completely different story. The refiners don't trade like the rest of the energy stocks. I mean, this does not look like XLE. It looks completely different, right? So the integrated stocks in the energy sector and the refiners look completely different. I think refiners are going a lot higher, and I think we want to be buying Valero, guys. I think Valero's got another 15 points to the upside. If we are above the downtrend line from the 2015 highs, we want to be long Valero, guys, VLO. Materials. Look at the highs in 2015. We broke out above it, consolidated, and are now resuming this uptrend. I think the XLB goes to 62. We want to be long XLB if we're above 53. That's 9 points of upside. And then here's the equally weighted materials, if just for confirmation, and we are also seeing new highs. So if you see the equally weighted materials down below 97, then we probably have a problem. Until then, just further evidence of an uptrend. Here are industrials. Guys, I just this weekend I ripped through all S&P 500 charts, stocks. So those are 1,000 charts that I ripped through, and we're gonna go over some industrials right now. But of any sector, I would argue probably technology and industrials have the most stocks showing the most strength and momentum. So those are two areas that we really want to be focusing on from an individual stock perspective. Look at the outside day that the industrials just put in. Took out the last 2 days prior, so just on a real short-term basis, evidence that this is not something that's happening, maybe a month from now. This is happening right now. Here's the equally weighted industrials, RGI. If we're above 105, we got to be very, very long industrials. Again, let me repeat, we don't want to be kind of bullish. We want to be very bullish of stocks and very bullish, particularly of the industrials, okay? We want to be buying them very aggressively, not just because of what the industrials chart looks like or the equally weighted chart looks like, but how many stocks look so good. And we're going to go over those now in a second. So here are railroads. We're going to go over some railroads that look good, but this 1380 in the S&P Railroads Index is one that we want to stay above. We are right there, so that's something we want to watch. CSX, I love it. If we're above 48, we want to be very, very long CSX with a target above 64. I love CSX. KSU, Kansas City Southern, if we're above 100, this is a long. It's been a long. It continues to be a long. I think we're going to 125. That's $20 a share higher. Look at Norfolk Southern. I think this is going a lot higher. We're at 124. I think we go to 135 short-term, 150 eventually. This is a multi-year base, guys. This is not something we want to be a little bit bullish of. This is something that we want to be very bullish of. Look at Union Pacific. Not the best of all of them, but I do think we resolve higher and head higher. So if I'm going to buy a railroad, it's not going to be UNP, but I do want to show that the resolution is coming to the upside. We're not getting downside resolutions. If we were down here, that's a different story, but that's not the case at all. Airlines are probably the worst part of the transports. Had a little bit of a failed breakout here. Probably got a lot of stop losses taken out, everything like that. I still think that if we're above the 2015 highs, the late 2014, early 2015 highs, if we're above that, we need to be bullish airlines, and we cannot be short airlines. I do think we get a mean reversion here in Alaska Air. Nice little bullish divergence. We still want to be kind of fading this area here, but this is not something we want to be short. Same thing with JetBlue. These are some of the airlines have been some of the worst performers. These are not things we want to be short. They're all positioned for major squeezes. Truckers, on the other hand, which have been our favorite part of the transports as of late, continue to outperform. The truckers look great. This is the Dow Jones Trucking Index, which should be making an all-time high any day now. Here's Landstar, which is a stock that we've loved. I still think we're going to 100, so that has further upside. Here's JB Hunt breaking out of a year-long base. If we're above 100, we want to be long JB Hunt with a target near 111, 112. Long way to go in JB Hunt. Look at Avis. Avis is one of the worst stocks in the Dow Jones Transportation Average, and it is now also breaking out of a multi-year downtrend line. So if we're above 36, we want to be long the car and taking profits around 47. So we have over 10 points, looking about maybe 23, 25% higher in Avis. Here's Ryder. A nice little breakout this week. If we're above 79, we want to be long Ryder, and I think we're going to 95. That's a long way to go. So short term, I do think we go to 85. These were the highs towards the end of last year. But considering this base, I think we're going a lot higher, and we're going to retest the 2015 high. So Ryder is a long. Expeditors, another good one. If we're above 57, we want to be long. I think we're going to 77. That's 20 points, guys. That's a major, major move. Kirby, not the best setup, but notice how we never got oversold. So the reason I bring up Kirby is not because I want to be buying an underperformer. It's because even the worst transports and the worst industrial stocks don't look that bad. Look at Kirby, which is a piece of crap, but it's not something we want to short. Look at the airlines. They haven't been doing well, but they're not something we want to be short. So even the worst stocks in this sector look good. Here's Federal Express, FDX. The trade has been very simple. If we're above the 2015 highs, we want to be long with a target of 262. That has not changed. We want to be buying any and all weakness in FedEx. Same thing with UPS. I do think we get a new high. We'll probably have some trouble around 120, but UPS, one of the underperformers in the transports, also not looking bad, looking like it's going to continue to go higher. So getting into some other industrials outside of the transportation space, here's Emerson Electric. I think this breakout is imminent. If we are above 61, we want to be long with a target of 70. Here's Ingersoll Rand, which is a stock that we've definitely liked. I continue to like. If we're above 85, we want to be long IR with a target near 109. So that's a long way to go. Further evidence that we don't want to be a little bit bullish, but we want to be very bullish. You know, here's L3 Communications and, or excuse me, L3 Technologies, and you know, no, we don't want to be long. The time to be buying this was at the beginning of the year. But, you know, go back and look at the the Q1 playbook for 2017 and you'll find it. But the fact that we're hitting upside targets is not bearish. That's bullish. It's when stocks fail to reach their upside objectives that we need to start worrying. So I wanted to show this not because we want to buy LLL, but because the fact that it's reaching its upside objectives is further evidence that we are in uptrends, not downtrends. Leggett, you know, a stock, you know, you can add it to the garbage list of industrials, and again, ripe for a squeeze, not something we want to be short. So even the worst stocks, so there's a lot of great ones in industrials and and some bad ones, but even the bad ones look like a squeeze is coming, not that they're going to roll over. I think that's super bullish. Here's Parker Hannifin, guys, PH. If we're above 165, that means we've broken out above that former resistance from the summer, and we're going to 214. That is a long way to go, and I do think we get that breakout soon. Here's Quanta Services, PWR. I do think that this base is almost done. If we're above 38, we want to be long with a target back up towards those 2,000 highs. Guys, that is a long way to go. Here's Republic Services, RSG. This is, you know, a stock that I've loved, obviously, but until we get to 71.5, that target has not been hit. So I wanted to show you still that we are in an uptrend and we still have a long way to go. And from a short-term perspective, we have respected this level based on this consolidation last year. If we, from a short-term trade, if we are above 65.5, we want to be long Republic Services, RSG, with a target above 71. Here's Rockwell Automation, one of my favorites, ROK. This is an uptrend. We want to be buying this breakout. I think we're going to 195. Here's Roper Technologies, and you know, I'm not showing you guys all these stocks because I think we should buy them all and own 100 stocks in our portfolio. Some of these are going to be more risk, you know, more attractive to some of you over others. But I think it's the weight of the evidence and the sheer volume of how many stocks are in uptrends, breaking out to the upside, not breaking down. ROP is another one. We want to be buying this breakout. I think we're going to 261. By the way, these are all S&P 500 stocks. These are all big stocks. Some of them might not be household names, but they're big enough and liquid enough to be in the S&P 500. So these are the real deal stocks, guys. TXT, if we're above 47, we want to be long. I think we're going to 57. XYL, if we're above 60, we want to be long. I think we're going to 68. ITW, Illinois Tool Works, if we're above 135, we want to be long. I think we go to 170. Illinois Tool Works. Here's Masco, guys, breaking out to new all-time highs. We need to be buying these stocks. We want to new all-time highs is the predecessor to even more all-time highs. Let's remember that. Here it is, Masco. If we're above 37.40, we want to be long with a target above 42. Here's Waste Management, breaking out to new highs. If we're above 76.5, notice how momentum never hit oversold. 76.5 is the level. If we are long, we want to be buying this. I think it goes to 86. United Rentals, URI, if we're above 120, we want to be long. I think we go to 168. So are you seeing how many of these names look good? Here is the Dow Jones Transportation Average, equally weighted. Notice how momentum never got oversold. So some people have problems with price-weighted indexes. I don't really. They're fine. But if you want to equally weight it, it also looks great. So further in industrials, guys, we are still in industrials. And look at aerospace and defense, ITA. This looks great. This is an uptrend, not a downtrend. If we're above 166, we want to be long aerospace and defense until it gets to $206. That is not a little bit higher. That is a long way to go. Further evidence not to be kind of bullish. Further evidence to be very bullish. Here is Lockheed Martin, LMT. I've liked it above 290 with a target of 330. That hasn't changed. We want to be buying any and all weakness if we get it. I think this has a long way to go. Another 10% of upside in Lockheed Martin. Here are financials. This is one of the most important indexes in the world on a weekly time frame, breaking out to new highs. That hasn't changed. If we are above 2380, we want to be long financials. Notice how in this correction we never got oversold. I think that is bullish for sure. So we want to be long XLF if we're above 2380. I think we're going to 2875. That is a long way to go. Here's Citigroup. Does this look like a major top? or does this just look like a healthy consolidation within an ongoing uptrend? I would argue it is the latter. And people talk about how the stock market is frothy and overvalued and all this garbage. Citigroup hasn't done anything since the crash, so it's flat since 2009. Clearly did not get the memo that stocks have been ripping ever since then. So there's a lot of catch-up, I think, taking place here in Citigroup, a forgotten name. We want to be buying this breakout. I think Citigroup goes a lot higher. And let me just show you guys what's going on in regional banks. Here's the all-time high in KRE in 2007, and then look at last week's lows. It was the exact same price. So this is a very important level. So as long as we're above last week's lows in regional banks, I see no reason to be bearish. Look at the failed breakdown that this thing put in, a bullish momentum divergence. This thing has squeeze written all over it, guys. We have, let me just reiterate, former resistance turning into support. So we have a long-term bullish catalyst, and then short-term, we have a failed breakdown, and from failed moves come fast moves in the opposite direction, bullish momentum divergence, stocks all over the world in uptrends. This has squeeze written all over it. We want to be buying banks. Hey guys, this is JC again, just rudely interrupting this conference call. I just want to ask if you are enjoying it. Is this the type of material that you want to receive on a consistent basis? I just wanted to show you the new Advisors Corner. This is specifically designed for financial advisors to quickly have a place for them to go. I realize that financial advisors wear a lot of different hats. Not just trying to service your clients, but also going out there and trying to grow your business. I get that. So the Advisors Corner is specifically designed to help the advisor by simplifying all of the research, keeping it in one place, not to mention the educational material that is also here and easily accessible. So guys, if this is for you, go to allstarcharts.com/Q4profits. And make sure to take advantage of the discounted offer. Thanks, guys. Insurance. I do not like the fact that we got oversold. I don't like that at all. But we did hold the support. So as long as we're above 59, there's no reason to be bearish of insurance. There's no reason to be bearish of financials. Here are consumer discretionaries, guys. Very important sector for sure. If we're above 91, we want to be buying this breakout in the XLY. I think we go to 105 in discretionaries. And if you guys remember, go back and look at the deep dive on retail that I did before I guess it was probably in July. Email me and I can find it if you guys can't find it. And look at the deep dive I did in retail stocks, and I said, this does not look like a major top. I think we squeeze, and I think that's happening so far. I think we do break out from here, and retail stocks go a lot higher. I don't necessarily think that we need to flip the book long retail stocks, but the fact that these are some of the worst performers are not breaking down, they're actually squeezing higher, is further evidence of accumulation, not distribution. Here we're looking at home builders within the consumer discretionary space. I do think that we're about to get a major breakout from resistance that's been in place for over 10 years. And here it is right here. If we're above 39.25, guys, we want to be long XHB. And I think we're going above 46. That is a long way to go on the XHB. So we want to be buying home builders. Look at momentum, got nowhere near oversold conditions. Here's technology. Here's a chart I continue to show since the original breakout last summer when we broke out of a 16-year base in technology relative to the S&P 500. This just is evidence that we have a long way to go in technology. I mean, this was the all-time high in 1999, 2000. I mean, look at all of this space. Further evidence not to be kind of bullish, but to be very bullish. And then here's technology on its own, similar to NASDAQ. If we're above the uptrend line from last summer's lows, we want to continue to err on the long side. I think we're going back to the 2000 highs in tech. Here's an equal weight technology, which this chart is a couple of days old now, but we want to make sure that we are above this uptrend line, and I think we officially are now again after the last couple of days. So this is definitely something we want to be watching. We don't want to be down here in the equally weighted tech. We want to be up here. So one to keep an eye on for sure. People talk about how the NASDAQ and the stock market are making all-time highs, but the biggest of them all, Apple, is not. What they are not telling you is that Apple hit our target, so there's no reason to be long. We wanted to be very aggressively long Apple this entire year, buying any and all weakness with a target of 162. That was the 161.8% Fibonacci extension of the 2015 to 2016 decline. That target has now been hit, and there's no reason to be long Apple. If we are above 163 and we're hanging out there for a few days, you know what? I think we could re-enter for another long. But if we're below 162, 163, I see no reason to be long Apple. Google, one that we've wanted to continue to buy on any weakness. I think we are going to over 1,000 in the Google, 1,030 to be exact, and we want to be buying this weakness. I think Google is going higher. Microsoft also breaking out above 71.76. If we are above that, okay, we want to be long with a target near 88 on Microsoft. Here's a shorter term look. 71.5 here in the near term looks like the key level. This is the 261.8% extension of the consolidation in early 2016. If we are above 71.5 in Microsoft, we want to be long with a target near $86 per share. Facebook, I love it. This looks like a very healthy consolidation, very normal. If we're above 165, the trade has been to be long with a target near 197. I still think that's the case. We want to be buying any and all weakness. Comcast, if we're above 38.5, I want to be long Comcast. This is still an uptrend. The momentum has not hit oversold conditions, so we want to be buying this weakness in Comcast and be long only if we're above 38.5 with a target above 42.80. Hewlett Packard, HPQ, a blast from the past. And if we're above 1870, we want to be long. These are the 2014, 2015 highs. I think we go to $24.70. That's a long way to go. Another example of why we don't want to be kind of bullish, but why we want to be very bullish. Global Payments has been one of my favorite names for sure. This is such a great stock. I think we go to 104. We want to be buying any and all weakness. The video game stocks keep doing very well. These have been my favorite names. They continue to be my favorite names. If we're above 61, 65, we want to be long with a target near 83. That is a long way to go. Same thing with Electronic Arts, EA. If we're above 108.5, we want to be long with a target near 168. These are huge bases, guys, and I think that there's a long way to go. Adobe, absolute monster. We want to be buying any and all weakness, target above 178. Autodesk, monster. We want to be long if we're above this uptrend line, target above 144. Oracle, monster. We want to be buying this breakout. I think we go to 55. Fiserv, look at this base throughout the summer. If we're above 123, we want to be long Fiserv, target near 142. Salesforce, you know, I don't necessarily think we need to be chasing it here if you're not already in it. We want to be buying this breakout, and we want it to be long above 83. That continues to go higher. I think we're going to 102. Total Systems. I didn't even know this company existed until earlier this year when it broke out of this major base. I still don't know what they do. I know that they're in the technology sector, but this is an absolute beast. This is when we wanted to buy it on this gap higher, right? It gapped above all that former resistance, giving the target near 68.5. That was hit. But it was hit through a gap higher again, very similar to this, above that resistance. So, well, we're not, just because they hit our target doesn't mean that we want to just completely ignore the information moving forward. I would argue that now, if we are above 68.5, we want to stay long, we want to be long, we want to be buying this stock, and we want to be taking profits above 87. Cognizant looks fantastic. Look at this base. If we're above 70, this needs to be bought. I think we go to 85. Look at this base, guys. Come on. HRS, Harris Corp, HRS, same thing. Look how similar to Total Systems, how we gapped up above that Fibonacci level. Same thing. If we're above 120, we want to be long HRS with a target above 150. Applied Materials. Look at this beast. I think we're still going back to those 2000 highs. Target above 57.5. We want to be buying any and all weakness in Applied Materials. LRCX, if we're above 140, we want to be long. I think we go to 221. Microchip Technologies, the trade has been to be long if we're above 76. Target of 100. There's another 12 points of upside here in the MCHP. NVIDIA, everyone's favorite name. This has been maybe the best performer over the last couple of years. I did see some stats. I think it's very simple. This is still an uptrend. Here are some key levels that are pointing to still higher upside. I think here's the trade. If we are above this downtrend line, we want to be long with a target of 204. This is still an uptrend. The market has respected these Fibonacci extension levels. Excuse my the amount of colors and lines here. You guys know how much I hate that. but I think the levels are really relevant. So we want to be buying this breakout, target around 204. Texas Instruments, I still think, like some of the other stocks, we're going back to those 1999, 2000 highs. Red Hat has been one of my favorite names. The trade has been be long above 100, target above 124. Look at this beast. I think that we have still probably another 16, 17 points in RHT Red Hat. And then finally, Netflix, guys, you know, we got the breakout with the gap higher above that Fibonacci extension. Here's the retest, right? And now we head higher. I think we go to 220. We want to be long Netflix if we're above 166. Tesla also breaking out of a nice consolidation. Are you guys seeing how many stocks are breaking out relative to the ones breaking down? And listen, yeah, I could have brought up Qualcomm and some other garbage out there, but they're so few and far between that we want to make sure that we are aware of the fact that stocks are breaking out. They're not breaking down. So I think Tesla's going well above 400. We want to be buying this breakout and be long if we're above the downtrend line from the summer highs. Semiconductors, the leading indicator for technology, guys, breaking out of this consolidation that we've been in. So here is ASML, another chip stock. I think we go to 195. Here's a closer look. The trade has been to be long above 136 with a target near 173. I think that that's where we're headed. And at this point, it's a little bit late to be chasing this if you're not already in it. But man, I mean, there's just further evidence that these things look great. Social media, all-time highs. I think SOCL goes above 35. We want to be buying any and all weakness. The internet stocks, this is the Dow Jones Internet Index Fund, and I still think we're going to 113. We want to be buying any weakness in internet and social media. Healthcare looks great, guys. This is a 2-year base and a breakout above this. I mean, this does not get any more clear. Momentum in a bullish range. We are breaking out to the upside. I think the XLV goes to 86.5. Here's a closer look. Resistance, nice little breakout this summer. Retest, and off to the races, guys. I think healthcare is going a lot higher. You know, for you equally weighted folks out there, you know, it also looks great. Multi-year base breakout. These are not sectors and stocks that we want to be shorting. These are things we want to be buying. Come on. Amgen, look at this multi-year base. We want to be buying this breakout on Amgen. If we're above 180, this needs to be a buy. This needs to be long Amgen with a target above 241. Celgene, same thing. Look at these bases, guys. And by the way, these aren't just bases coming from downtrends. These are bases within uptrends. These things are monsters. I think they go a lot higher. If we're above 142 in Celgene, we need to be long. I think it's got 30 points to the upside, and we go to 172. Biogen, not one of the strongest ones, but breaking out. Another example. You know, Celgene and Amgen, two of the strongest. They look great. They're breaking out. But Biogen, not the strongest, but not breaking down. Also trying to break out in its own right. So maybe not something that we need to be flipping the book long, but of course, for sure, being aware of the strength. So we have gone a full hour already. I obviously had a lot of stocks that I wanted to show you guys. So before I let you run, I do want to look at some commodities and show you guys how some of these commercial hedgers are positioned. Here's crude oil. I mean, talk about something that's perfectly priced. We are sitting right at a flat 200-day moving average. Crude oil has literally done nothing for 3 years. There is no trend, so let's be aware of that as we move on. And then there's a very high correlation that I'm going to show you in a minute between oil countries and crude oil. So here's an equally weighted chart of Brazil, Russia, Australia, Canada, okay, breaking out to new all-time highs. So here's a shorter-term look at the oil countries, equally weighted, and then show you what they look like together. They look exactly the same. So the fact that these countries are breaking out to the upside is evidence that we don't want to be shorting crude oil, okay? It doesn't necessarily mean we need to be long, but we don't want to be short either, okay? And then here's crude oil, and these are Russian stocks, RSX. Again, they look very similar, don't they? But Russian stocks are breaking out. So crude oil should follow along as well. Further evidence that we don't want to be short crude oil. And then here's heating oil, breaking out to new multi-year highs. Very high correlation with crude oil. So a lot of evidence is pointing to us not wanting to be short of oil. It doesn't mean we need to be super long, but not short. And that's, you know, more catalyst for upside in some of these energy stocks, which I think is bullish overall for equities. Natural gas, very perfectly priced. I don't think there's anything to do here at all, but I did want to mention that because I know a lot of you guys are interested. Here's gold. Really been in the talk of the town as of late. You know, anytime gold does, you know, moves 3%, the gold bugs go crazy. But we are still near this overhead supply around 1380. Yes, we broke the downtrend line that went back 6 years, but listen, you could have bought freaking anything in the last 4 years and made money. You are flat gold here, so there's still overhead supply near 1380. Keep that in mind. Not to mention that commercial hedgers are net short 261,000 contracts. This is one of the biggest short positions in the history of commercial hedgers. So the smart money is very aggressively short gold here, very similar to where they were up here, and they were right. So I'm going to err with them, and I'm not going to be buying gold here. I'm not going to be shorting gold like they are, but I'm certainly not going to be buying it. Here's the gold miners ETF, GDX. I see a failed breakout. So from failed moves come fast moves in the opposite direction. I would be willing to bet that gold miners are probably going to be somewhere around here over the next couple of months. I just don't see tremendous upside here yet. By the way, if I am wrong and we do get back above here, I would argue that would be very bullish catalyst, and I would need to reevaluate my thesis depending on where the commercial hedgers are at that point. But that would be very bullish if miners are up here, but they're not. They're down here. So I think they're going to stay down here for a while. Here's silver, still overhead supply for sure, and commercial hedgers are net short 76,000 contracts, some of the biggest short positions for silver commercial hedgers on record. So commercial hedgers are super short silver. So why do we need to be overly aggressive? If there was real risk appetite for precious metals, guys, silver would be outperforming gold. Here's the silver gold ratio, and here's silver itself. Okay, so you know we're in a sideways range in silver itself and gold for that matter. But until silver starts breaking out relative to gold, I am not going to get behind this. If silver is where the crazies live, guys. We want to see what they're doing. If there is real risk appetite for precious metals, silver is going to be outperforming gold, not the other way around. So if you want to be bullish gold, talk to me when this ratio is up here. Palladium's the one that's doing so well. Palladium's the one that's breaking out to new highs. So we've wanted to be long palladium if we're above 913. I still think we're going to 1200. I don't know why it doesn't get much attention, but it's certainly the best of the metals. If you're going to be, listen guys, if you're going to invest in a bunch of rocks, do you want to be investing in the strongest rocks or the weakest ones, right? Speaking of strong rocks, here's aluminum. You know, there's a big base metal sort of thesis, you know, theme that I'm seeing with Australian dollar breaking out, strength in Latin America, and some of the mining and metals companies and stocks and sectors in the United States. So there's a big theme there. Here's aluminum breaking out of a 9-year downtrend. So just keep that in mind. Here is an equally weighted chart of the base metals, copper, aluminum, nickel, tin, zinc, and lead breaking out of a 6-year downtrend, okay? So here is that same base metals index breaking out. And then here are the BRICS currencies equally weighted, right? Brazil, Russia, India, China, and South Africa. So look at the correlation between base metals breaking out and the BRICS currencies breaking out. So further evidence of that strength in emerging markets, that theme, we're seeing the correlated areas doing well. So this is the question. If you're going to invest your money in a bunch of rocks, do you want to be in the weaker one or the stronger one? Do you want to be in the one showing relative strength or the one showing relative weakness? And copper breaking out versus gold is evidence that they're buying the base metals, not the precious metals. Moving over to grains, I put together this equally weighted chart of the grains, food, and fiber. So this includes corn, sugar, OJ, cotton, coffee, oats, soybean meal, bean oil, wheat, and cocoa, equally weighted, because notice how the commercial hedgers have historic net long positions in cocoa, coffee, and sugar. So the smart money is buying these things. I don't necessarily know that we want to be flipping the book, buying all these things across the board today, but I do think that the positioning and the basing period is worth following. And one of the more attractive risk versus reward propositions would be if cocoa was above 2,000. If cocoa's above 2,000, we want to be long for a mean reversion here, considering the fact that commercial hedgers are net long 32,000 contracts, an all-time record high. we don't want to be short. So if we're above 2000, we have to be above that level to be long. In other words, be long only above the 2012, 2011 highs for a mean reversion towards 2700. So here's the U.S. dollar, guys. I would be irresponsible not to mention this. You know, considering where the commercial hedgers are near record positions in the euro, short euro. They're short 120,000 contracts. Okay, guys, this is they're buying dollars. So the smart money's buying dollars. I think this is a failed breakdown below those levels. Okay, so this is the exact opposite positioning that we saw coming into the year. Okay, when commercial hedgers were super short dollars and they were the speculators were long. Now we have the exact opposite. The commercial hedgers are long dollars, short euro. If we're above 92 in the U.S. dollar index, we want to be long dollars and short euro, along with commercial hedgers for a major squeeze. I think we go to 98 at least in the U.S. dollar index. So we want to be shorting euros, guys. Dollar yen, you know, this looks a lot like Japanese stocks. Notice how momentum never hit oversold conditions. If dollar yen is ripping, that means yen is getting slaughtered. So if yen, treasury bonds, and gold are selling off and stocks are going up, you know, that's just evidence of risk appetite, guys. So a weakening yen for sure, I think, is a tailwind for U.S. stocks and stocks in general, really. So in bonds, I see a failed breakout here. It looks very similar to gold miners and some of the other, you know, looks like the opposite of regional banks, for example. So I think we short U.S. Treasury bonds if we are below the June and July highs up here. I think we could be short U.S. Treasury bonds, you know, really down towards this 122 level. So I think there's a long way to go to the downside here in bonds. And then in the U.S. 10-year yield, it's the exact opposite. Notice how in this pullback, momentum never got oversold. I think that this breakout is now being retested, and then we break out from here. One of the things I'm looking at is the gold-copper ratio breaking out. The copper-gold ratio looks very similar to U.S. Treasury bonds. As you can see here, they look pretty much exactly the same, guys. So if you want to know where rates are going, look at the copper-gold ratio. I think copper-gold ratio goes up, and I think interest rates follow for sure. One of the leading indicators that we've been looking at in the U.S. Treasury bond market and in interest rates has been the U.S. 5-year yield. I think that this was a failed breakdown. Notice how momentum never got oversold. I think 5-year squeezes along with 10s and along with further upside in copper versus gold. Looking at the yield curves, these are, you know, some of the most popular yield curves: 30s minus 1s, 10s minus 2s. I think these are going higher. I think, you know, expect this yield curve to continue to widen. I like the failed breakdowns in 30s minus 1s and in 30s minus 3-month bills. I've been pointing to that since they occurred. I think that the path of least resistance here is higher across the board. And then another spread that I want to make sure we're watching is U.S. 10s versus Bund yields, and I think that they are going higher. I think that this breakout is now successfully being retested. There's a very high correlation historically between U.S. 10s and 10-year bunds, and if this is successfully being retested and we rip higher, I think that that is going to be a tailwind for the U.S. stock market, guys. So I update this chart regularly in the bond and interest rate section of the workbook, the bond workbook in the chart index. So take a look at that, and I think that we're going higher in both of these. So if this starts to break down and we're down here, then we're going to have to reevaluate our bullish thesis, because I think this is an important one. And then just want to finish up with this chart, because I really think it tells the story. You know, one of the things that we want to talk about is in the stock market, are we, if we're going to be so bullish of stocks, which we are, if I wasn't clear enough that I like the stock market here and I think we're an uptrend, let me just reiterate that one more time. I like stocks. We want to be buying them very aggressively. In order to be doing that, we want to make sure that stocks are not just performing on their own, but they're also performing other asset classes, that they are relative outperformers. If we are buy-side fund managers, we want to be looking for two things: momentum and relative strength, not just against its peers, but against other asset classes. So here's S&P 500 versus bonds, and here's S&P 500 versus gold, okay? We want to see breakouts in both of these indexes very, very soon. I do think we get them. We are not seeing breakdowns, so that's one good thing, but we're not getting the breakouts yet. So we want to see breakouts in both of these indexes, and I do think that we're going to get them. So I know that we ran late, guys. We had almost 200 charts. So cut me some slack that I didn't get to the questions, but you guys know where to reach me, allstarcharts.com/premium-contact, and just ask me whatever you want. Steven, I know I didn't get to your question. I know there were a couple of other questions as well, so sorry for that. But I did have a lot of really important charts that I wanted to make sure that I get across. Best one yet. Oh, thanks, Natalie. I really appreciate that. Guys, I hope that I was very clear. I laid out my case. I mean, this is what I see. I think that there are so many opportunities out there right now, more so than usual. I don't think that this is a crazy market. I don't think that this is a market that we haven't seen before. From the bottom of my heart, as somebody who studies the stock market every day, and when even in my off time, I'm studying older markets. I'm reading Charles Dow's letters from the late 1800s. Guys, this is as normal as a stock market that we have ever seen. I don't care about the U.S. debt, or I don't care about who the president is, and I don't care about the Federal Reserve. I don't care about any of that stuff. With respect to the behavior of the market, this is as normal as it gets. So let's not forget that. Thanks, guys. Ladies and gentlemen, thank you for listening to the September conference call for members of All-Star Charts. Now that you've had an opportunity to see what this is all about, I encourage you, start a 30-day risk-free trial. It's a money-back guarantee, and we are offering a discounted membership. Traditionally, it's $397 per quarter. We're going to offer it to you for $297, and then the annual membership, of course, $1297. We're going to give it to you for $997. This includes the Advisor's Corner, my personal chart book with over 500 charts consistently updated. I'm willing to do some custom charts for clients. We do it all the time. A weekly newsletter, usually more than one a week, of course. The actionable trade ideas, and then the monthly conference call that you just heard. We're going to do that every single month. So go to allstarcharts.com/Q4profits and start your 30-day risk-free trial today.